back at the speculative moves that have really made a difference to me, the 10 baggers, the 15 baggers, the 20 baggers, characteristically, they took 5 or 6 years to work out. I may have wanted them to take place in a quarter, but what I wanted is irrelevant. Why want what you can't have? They did take 5 or 6 years. And by the way, almost every 10 bagger I ever enjoyed delivered me a 50% share price decline sometime during my holding period. So in addition to being patient, you have to be persistent. And people who pay too much attention to the Fed and not enough attention to the underlying investment attributes, and people whose time horizons are inconsistent with the time demands to achieve the investment outcomes that they're trying to cause to occur, are doomed to failure. If you have a 3-month orientation in what is a 6 or 7 year cycle, you will snatch defeat from the jaws of victory just because your investment orientation is out of sync with what is required to experience the outcome that you're hoping for. It's very perverse. 2023 has been a very good year for me. I think the aggregate of my managed accounts are up sort of 22 or 23%. So I would suggest that the junior miners are suffering malaise of their own making. We've described before that if the universe is 2,500, I don't know what the number is, probably 2,000 are valueless. And if you look at the fact that probably 80% of the listings are valueless, maybe 75, the fact that we still have a junior market at all is heartening. I would point out the performance of those companies who have delivered. The so-called boring sector, the construction and development phase. What you're doing is you're watching some of the companies that are doing a good job there really, really, really perform. Perversely, those who hadn't performed before and gotten ahead of themselves. And you're finding, too, those companies who are delivering good exploration results, albeit they're few and far between, being rewarded in the market. What you aren't seeing is a return of the dumb money. You aren't seeing the type of speculator that you would have seen in the market in the sort of 2010, 2011 phase, that sort of thing. You haven't seen the incredible rush of dumb, narrative-oriented money into the market. From my point of view, that's a good thing. One further bit of editorializing. Despite the fact that I guess I don't need to, I'd like to become wealthier. And you become wealthier by buying assets when they're out of favor and selling them when they return to favor. So the fact that the industry is in self-described torpor, for me, isn't a bad thing. It's a good thing. I'm a buyer. Now, I can't say that the torpor has been such that I have been able to buy with abandon, but I certainly am impressed that some of the stocks that I would like to buy, the Centauruses of the world, the Silvercrests of the world, some of the explorers have enjoyed, if that's the right phrase, no share price appreciation, in fact, share price depreciation, when the underlying value of the company continues to increase quarter by quarter. From my point of view as a buyer, that's a wonderful thing. That's not the way I think.
Yeah.
I think a dip in the junior mining sector would be for it to go to its intrinsic value, which is 0. I would describe these as perturbations, not dips. What I try to do is I look at a whole company and I try to anticipate as best I can what it's worth and what it's likely to be worth in 18 months and then 5 years, based on a set of circumstances, probabilities that are, to my mind, more likely than not to occur. Let's say that I think that XYZ company is likely worth $1. And let's say that by answering a series of unanswered questions, I think it's likely to be worth $2 18 months from now. And let's say that I think it's possible that 5 years from now, it could be worth $10. If that stock is selling for $2 now, and I think it's likely to be worth $2 18 months from now, obviously I'm not going to buy it. Why would I pay for 18 months of stagnant value creation? If by contrast that stock is at 80 cents or 75 cents, I'll likely buy some. And if I've done all the work to establish what I think it's worth and what it's likely to be worth, and it falls from 75 cents to 50 cents, I'll likely fill my boots. I think the high-quality junior market is very much like the U.S. housing market, which is to say there's a gap between the bid and the ask. Existing investors and managers are trying to get 3-year-ago valuation levels. And investors like myself are trying to get 10-year-ago terms. If somebody wants to come to me with a market-related financing, let's say the stock's selling for $1 and they want to do the financing at $1, and they want to give me restricted stock, they better give me a warrant. If they don't give me a warrant, I will, quote, as you say, buy the dips. For sure, in the next 4 months, 5 months, 6 months, something will happen which will give me a buying opportunity. And if I don't get a warrant, why wouldn't I buy unrestricted stock in the free market for a savings? Now, I will say I've been much more active in the lending side of the business because equity has become more expensive. More companies have decided that their shares are genuinely undervalued, and they've chosen the inconvenient method of having to pay me interest. And of course, they've taken the risk of being unable to pay me back by going into the debt market. If a company really truly believes that its equity is 50% undervalued, then borrowing money at a 12 or 13% interest rate is actually cheap. What you'll find is that this apparent undervaluation only exists in news releases, not really always in the mind of the insiders. But increasingly, we have a circumstance in the market now where the insiders and their backers are coming to believe that their stocks are undervalued by 40 or 50 or 60%. And in that case, doing debt transactions has benefit to them.